Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to Richard Penny of Crux Asset Management, one of the UK's finest small and mid-cap investors. So welcome, Richard.
Thank you, and good morning.
Yeah, well, a lot's been happening since we last spoke about sort of 4 or 5 months ago, and not least have had central bank tightening. Now they've decided to push interest rates up, and likewise we've had elevated inflation, and now we've got sort of like obviously the geopolitical concerns in Russia and Ukraine. So what's your sort of outlook for equities? I mean, everything's been thrown at the stock market of late, but what's your outlook for equities going forward?
Yeah, so I'm focused on the UK, and actually we're very much bottom up. So, you know, markets have come off in some places, so we see opportunities. But to answer the question directly, if you take equities globally, then obviously they're dominated by US equities. We look at a thing called a cyclically adjusted PE, which is basically taking the 10 years of profits and then taking the market level and dividing it in. So it's like a smoothed earnings level. That's been really relevant because we haven't known really what the earnings power has been in the last 2 years because of COVID. So that shows the UK at about a cyclically adjusted PE of about 12.5, 13 now after the move this year. And the US is on about 30. So, you know, I know. And it's been a very good long-term indicator. And I think it's better than trying to predict the economy in many ways. So if you start from a low valuation, you tend to get good returns. So the historical sort of record would say the UK has done about 7 or 8% for the next 15 years from that level. The US, you might get 1 or 2%. And then a lot of so that's the cyclically adjusted PE. Quite a lot of the other measures, like, you know, the free cash flow yield on the UK market versus the US. UK is on about 6.7%. The US would be on about 4.3%. So we would be 50% cheaper if it was like-for-like businesses. Of course, the US has got more technology. But I think, again, there's quite good news this year there in that, you know, a year ago, I would have probably said, well, we've had the vote on Brexit. The UK's cheap market. It's not all explained by it being value sectors that we're in. But actually, we didn't really see a recovery last year because growth was strong again. So I think it's something like 13 years out of 15 good for growth versus value. Now, growth became as extremely valued, the most expensive shares versus the least expensive shares ever in the last sort of 12 to 18 months. So I think kind of what's going on with global markets is a repricing of growth stocks after they've become very, very stretched. And the US is quite vulnerable to that. Interest rates going up is bad for growth stocks. It's actually quite good for banks. And then we've got the reflation trade. You talked about inflation trade, which is good for oils, where the UK is. So there are reasons why the earnings are getting stronger in some of the value sectors the UK is kind of in.
Yeah, so you think that the rotation from growth into value will continue to at least to normalise the valuation profile. But just on that, and on obviously the higher inflation, what's your view about Russia and Ukraine at the moment? I mean, and obviously it's a pretty much a $60 million question, but is that sort of like a bit of a storm in the teacup, or is it actually something more serious?
So I don't think I can really add anything other than listen to the radio, which obviously I've been doing this morning, and all the listeners would have been doing as well. I think it has been quite well flagged, the one thing I would say. And I was aware we might talk about this, so I had a little look about political events since the Second World War. And, you know, the ones where there have been real moves in the markets have been the sort of foreseeable events, like, unfortunately, terrorist attacks and things, where they come as a complete surprise to the marketplace. I mean, if the UK and other markets take their lead from the US, I mean, if you go back to the Second World War, in fact, the US stock market was not at all bothered about the Second World War until about 6 months before Pearl Harbor in 1942. So the direct effects may be some of that's already baked into the market. Clearly, there's a lot of people who analyze these sort of things day in, day out in the oil markets as well. They'll be all over this. You know, there is a prospect that we will have volatility in markets and that the oil price might spike up another $10 or $20. But I'm just reminded of things like the Brexit vote and Trump winning the election, where you wouldn't necessarily have forecasted them happening, and then the opposite happened in end markets. So forecasting macro is really difficult.
Yeah. Okay, well, let's have a look at some sort of stocks. And I did see you've got got a good high conviction plays, and one which sort of like really springs to mind is FD Tech, that I think was the old formerly First Derivatives business. That is a sort of like an amalgamation of software and high value services for sort of fintech, the fintech industry, or for big merchant banks. Do you want to take us through that one?
Yeah, I mean, this is really high conviction for me. I see these shares as really good value below £20, and you know, the directors are buying them at £19. They're currently £14.40. They are caught up in the growth sell-off. It's really three businesses, as you point out, and sometimes that's just too difficult for the market. But the First Derivatives consulting business has really been the driver over the last 14 or 15 years that I've known it. There is a software business called KX Systems I'll come on to in a minute. There's also a marketing service business, which probably will do about 10 million of EBITDA. The consulting business and the marketing service business are worth probably the market cap. So that gives you this kind of jewel in the crown, KX Systems. It's a time series database, so people do use it in investment banks. It processes data really quickly. It's very relevant to Internet of Things, artificial intelligence, these kind of things. It's established, but it's been niche. So it has its own special language, this software, and it's a global business called Q. Now that's in most of the investment banks, but to really scale and deploy in the Internet of Things and these other applications, you kind of want it written in other languages, and that's what's happening. It's getting written in Python and to some extent SQL, which means that it's, rather than being the masterpiece written in Estonian, suddenly it's sort of it's readable in English or Spanish. It's that difference where people will be able to deploy this. KX Systems, this database area, this streaming analytics, really, really valuable in the US. So there's companies like Confluent that have got a product called Kafka on 30 to 40 times sales, when you look at this year or next. The business floated called MariaDB, again, it's on sort of multiples of sales. UK WANdisco at 13 times sales. So if we have the first two businesses that are worth roughly the market cap, sort of 15 quid, today the KX Systems we value at 5 to 10 times sales, which is a fraction of what the US is at, and can give you 50 to 100% upside from here. But it is in and of itself a business that will probably double its sales over the next 3 years. Now, it just so happens the business has been doing well, but they've chosen to invest in that business. The some of the parts argument, you might say, slightly contrived, but I think the impetus will be now on the management to either realize the value somehow, or somebody will do it for them.
And just on that KX Insights software business, which is the sort of the jewel in the crown, how scalable is it outside of its traditional capital markets focus?
So they already, I mean, they've got about 50 million in sales, and annual recurring revenue, ARR, which is what the market values, and about 20% of that currently is outside of that. But they've started to get some of the sort of land and expand kind of deals. They're sort of, you know, really good reference clients like Williams in Formula One. They've also got some healthcare customers where it's been trialed in one operation, but it could go out to another 60. And even that one client might go from 200,000 or 300,000 pounds of revenue. That could expand to 20, 30 times over 2 or 3 years. And then obviously, or not obviously, but they have spent, and they've made a conscious decision to spend about 15 million pounds to grow this business. That was probably growing at 20% anyway. They made a conscious decision to grow it, and that should add roughly 10 million to this ARR. Now, when you look at the multiples on the ARR, that's a great payback. I look at it in the context of the business doing 200 million of turnover, adding, in aggregate, adding, 10 million to that doesn't seem that great a trade-off for the 15 million of investment and loss of profits that it was making. This was a profitable, well, it is roughly break even, but it was very profitable. But of course, as it grows the revenue, it will become increasingly profitable. So I do see, this is actually an American business, and some of the advisors they've appointed are based in America. It's based in Palo Alto. I do see this sitting very comfortably at some point in an American business or on the NASDAQ, probably on a 2 to 3 year view.
Yeah, and I do understand actually the software side of it's now almost fully through its SaaS transition, isn't it? Because that's sort of artificially depressed some of the growth rates because it's moved from a perpetual license into a SaaS license. So it looks as though it should be all systems go from here.
Yeah, well, it should be, and to the point of where it's sort of, if you like, putting its worst foot forward. I mean, that ARR, which I'm using to value, I'm sort of ignoring the other revenues outside of it. But it's 47 million, should be at the end of the year, and it should go at probably so that it's such that it doubles over 3 years, I would think.
Well, yeah, I'd certainly say to investors have a good look at FD Tech because it certainly looks like an excellent unbundling some of the parts play. No doubt about it.
Yeah, I believe so.
And what about Inspecs? Because I understand that's a designer, manufacturer, and sort of distributor of sort of like eyewear frames and optically advanced lenses and stuff like that.
That's right. Yeah, I mean it's a long-term growth business. It's kind of a tuck away one. Any volatility in markets you just buy, and in my view, sort of thing like historically like a Decra that has been brilliant. It could be brilliant for a number of years. It's it floated in February 2020, so not necessarily the easiest time, if you recall. It's been hit. It's dealt with, and it's hit its numbers through COVID, through supply chain issues. And that isn't because there aren't any issues, it's because the management have managed that process incredibly well. And they also bought a business called Eschenbach, which they bought for a good price because of COVID. And it just, management owned 20% of the business, which is, a meaningful amount of money. And where they buy things, they are genuinely, I believe, adding. So it's one of the top 10 manufacturers. The biggest by far in the world is EssilorLuxottica. But increasingly, you're seeing with Inspecs, they've gone from having frame manufacture, probably quite a concentrated list of clients, much more broader. They've got more brands. They've got a stable of about 20 or 30 brands or sub-brands. Some of them are industry brands that go into the independents. They've got much better geographical fit, and they're getting synergies. So they bought a glazing company or a lens company in Gloucester, invested in that, and now you can actually put the lenses in the glasses. You can do full service to the independent opticians, and there's a possibility with the stable of brands they've got, they might be able to, go into a Target or a Walmart, not offer a whole sort of buy all your glasses here type thing. So I just think the management have done incredibly well with the numbers. It's about a 30% discount to Essilor. It should be, because Essilor is a very big business. It's on about 25 times, which is not cheap, but they've actually put in some quite painful forecast for supply chain and COVID. Obviously, COVID sort of is the same as it was last year, which I think would be disappointing to all of us if it was, given it's definitely improving. So I think even with those sort of things, it can probably beat the numbers 10%. But there's definitely a COVID recovery, and then take market share and possibly further acquisitions as well.
And I'm guessing as we sort of have this inflationary environment and we're looking for stocks with pricing power, given it competes with the likes of sort of Oakley and Ray-Ban and Gucci and Armani, all these guys have huge pricing power. So presumably if the market price point goes up, then these guys have also got pricing power as well, and therefore their on costs in inflation they're seeing, they can at least recover that, I presume anyway.
Yeah, I mean, a lot of what they do is branded or trade brands, so they will, it's about service and quality of service. They have to be slightly careful about how much they put their prices up, but I mean, I know that when you buy glasses, they're not the cheapest of things. There's lots of margins for the manufacturers and lots of margins for the optician. Just from a product point of view, you can put the price up a little bit. And then, of course, the bigger prize is that where they've made some of these acquisitions, they can do more manufacturing. So they would put those through their own factory in Vietnam and China. And then, of course, if you're doing the glazing as well as the frames, then there's so much more margin to go for anyway. I would say they should be pretty well protected.
Yeah. And then another one on the geopolitical sort of front, I guess, which will play out is Chemring, which is obviously a defence business that is well known, world renowned for its flares and for sort of like encounter measures out of helicopters. And it did really, really well, I think, in the Iraq warfares, the Middle East and stuff years and years ago. But I guess, with consolidation, in defence, etc., then this one's a good. It looks reasonably cheap, actually. It's only about 15 times PER.
Yeah, it is surprising. You've had Cobham and Ultra and you know, a number of the businesses go. Yeah, it's doing well, and it's improved. I mean, it did do well in Iraq, but it's tidied it up, so it's less commodity business. It's all high value added, good market shares, and there are some quite big contracts out there for protecting against chemical warfare and that kind of thing. So they may or may not win, but that would be upside. Balance sheet looks quite clean. And they've got a really good business called Roke, with an R, ROKE, which is kind of artificial intelligence, cyber security networks, electronic warfare. Obviously, huge defense clearance, but it's employing sort of 600 very clever people. You go on Companies House and look at that. That has just been a fabulous business. It's sort of making about 20 million of profit now, I believe. But it's grown its revenue steadily. The profit's gone up very, very nicely. It looks exactly like the kind of growth businesses people pay 20 or 30 times for. So you're right. I think Chemring, as it is cheap, but with that Rogue, the sort of you know, the cyber security play, which is very, very current as we speak. You know, I think some of the parts is quite a lot more, and as you rightly point out, possibly a takeover candidate. I think the whole thing.
And how big in terms of turnover is Rogue? I mean, I did notice the sales are about just over 400 million, but it's sort of 60, 70 million of EBIT. And so 20 million of profit for Rogue is almost a third, actually. But how much is this?
It'd be a lot less than that. It'd be a higher margin. It's a higher margin business. I think they make a 20-25% margin, whatever that. That's probably, I don't know, it's probably something like 50 to 100 million, I think. They're not always, it's not necessarily separately disclosed. Actually, because I haven't actually seen yet the number for this year from Companies House, but they're guiding towards it being more like 20 million this year.
Right. Okay.
Whereas you've seen 10 million historically.
Yeah. No, I know Andy Brough from Schroders, another super smart investor, also likes Chemring. So I think you're in good company there. Now I see you've been on your bike as well with Halfords. You want to take us through that? Because that is, I mean, I just cannot believe that is a super cheap, sort of 9 times price earnings.
Yeah, I think, you know, consumer stocks in the UK have been generally sold off. There's quite a change going on in Halfords. It was the high street retailer. Maybe they did suffer some competition from online retail of things, but it's moving towards services for cars. So they've management are incredibly impressive around doing this and sort of kind of standardizing jobs that get done when you go in and get your car serviced or your MOT. But they bought a business called National Tyre, which is about tyre fitting. So that's a consumer brand, but also a wholesale brand as well. And the savings, I mean, that moves the percentage in this service area up past 40%. And also the earnings and the synergies for that come through into 23 and 24. So what's cheap now gets cheaper as you go out and, as I say, into 23 and 24. And, you know, very good management. It's a change business. I don't necessarily think the market's sort of gone for that or working up for it. But what you will see is improving kind of metrics in terms of return on capital and those kind of things. And that's what, you know, people have historically paid up for. So 8 times feels about 40 or 50% too low, really.
Yeah, it looks ridiculously cheap, particularly as like if it's going into sort of the auto repairs and stuff like that. I mean, I know with EVs, they're going to have less moving parts. And so the argument is that actually they'll require less sort of servicing. But frankly, all the EVs that I see are actually having to do servicing and having to be repaired because they can't move. It's raining and they've had a problem. So they're in the garage. Yeah,
there is. And also, if you look at an average town, there's sort of 20, 30,000 people that might have 8 or 10 garages. Well, you know, the kind of kit that you're going to need to do electric vehicles is going to require investment. And, you know, I think you probably see, you know, 1 or 2 of those 8 or 10 go out, you know, just decide to throw in the towel or maybe sell to a Halfords because you're just going to need diagnostics and things that they just won't pay up for, really.
And then you're just moving on. Then you've got a bit of a sort of a commodity play, or should we say in food anyway, which is a high conviction MP Evans, which is a sustainable palm oil manufacturer out in Indonesia. And I'm guessing it wasn't hit because it had huge monsoons, didn't it, or cyclones in Indonesia. But I guess it hasn't been impacted by that, has it?
It hasn't been. I mean, it's just been doing incredibly well. I mean, there's kind of four things going for it really. So the first two are that it spent about $500 million in the last 10 or 12 years, and the plants, the farms are at a level where they're just producing increasingly more and at, good level. Plus, they're filling up their own mills because they own, it's a huge area that they spent this $500 million on. And so they're getting greater margin for processing as well because they're displacing product that they buy in. And then there's two other factors, which is the palm oil price. To some extent, things like palm oil can sort of get into biodiesel and stuff. So, it's about 1460, having traded much of the last 5 years below 1,000. So it's high in the way that inflation is driving a lot of commodity prices up. Plus, just very recently, there's been a reversal of a tax, a duty thing in Indonesia, which is giving them quite a lot more per ton. So, I mean, what you see with this is because when the trees are planted, give or take the odd weather pattern, as you point out, it's going to increase the crop each year. We don't know what the price will be, but we know that as it increases, they'll put more through their own mills. So they kind of model it on a $200 margin against their costs versus what they net against taxes. And that gets you about 100p of earnings against an £8 share price, just shy of £8 2 or 3 years out. But they model it that way. If you look at the material on their website, which anybody can do, they're currently clearing about $500 the way I look at it, just because of the $1460 the Rotterdam price, which you can look at on the internet, and the tax structure. So, I think actually put it a different way, around 100p of earnings, you're probably looking at 100p of dividend, and probably growing from there. There's other things they can do to build it. And it's a bit unfashionable and unfavorable. But, PLCs, Western owned with Western, institutions looking after them have to do the right things. They do have sustainable palm oil. They're repurposing former rubber plantations. They're not chopping down virgin forests or anything. So I think for our fund and our strategy, that's going to be very good. It's a nice tuck away.
Yeah, it should be a good, decent inflation hedge, you'd have thought. I mean, but hey, you can never tell with obviously soft commodities.
As the oil price goes up, then it tends to be slightly positive on the palm oil to some extent.
Another one which is a high conviction, which is a reopening play, is XP Factory, which is a former escapement. And I know one of my colleagues at Vox, Justin Waite, loves it. So, and he, particularly the acquisition it did, which is the Boom Battle Bars. I don't know whether you've been there, but do you want to take us? Because it's only a 41 million market cap business.
Yeah, I have been there. I mean, I did a recovery in the escape hunt business. I mean, it got down, I think we bought our shares at 10p and 6p. And I think that business could have sustained 30 to 50p maybe over 2 or 3 years. But the thing is now transformed with this Boom Battle Bars. So they bought it, and there's a pipeline of about 21 sites that have been where the property deal is done, but that potentially goes out to 40. Now, I think 5 of the sites are company owned, the balance being franchised. So they're not all owned, but the economics are still pretty good on the franchise. It's basically, as you say, it's an unlock play, but the property deals for this, it's larger than a standard kind of retail site, they can be really quite big. And they're pretty important for developments that people have for landlords, because when you have experiential leisure, so Boom Battle Bars is sort of, it's getting people in there, darts and sort of Bavarian axe throwing.
It's axe throwing, isn't it?
Yeah, I know. Apparently you're not allowed to drink before you do that. So you have to do
well,
that.
I can understand that.
Yeah, I was very disappointed. I think I'd sort of just sipping on half a Guinness, and I was told I wasn't able to start yeah. No, but I mean, basically the property deals are the fit out costs. They get contributions to those. They can get rent-free periods and reduced rents anyway. So I happen to think the format is really pretty good, but the property deals are just exceptional. So, and in particular, there's one site on Oxford Street, which I think the company are modelling it as it could potentially be twice the normal economics of a unit, but it's the sort of outlet that could make 5 or 10 million of revenue and be doing 2 or 3 million of EBITDA, which I mean would certainly be in and of itself would be sort of transformational versus the former escape hunt business. And actually, there is the scope to put these escape rooms into these sites as a sort of incremental thing that people do when they go in there, and the economics is so much better because people will spend on the bar, and you don't have to have the people on reception because they're already in these boom battle bars. So I just think the economics of the whole thing is a lot better, and yeah, it should be a good unlock play as people get out and about.
And I'm guessing that, I mean, there's opportunities overseas, isn't there? Because you'd have thought, I mean, the US would love this type of stuff. In fact, probably the ex-Viking countries also would like it in Scandinavia.
I'm sure they would, but I think there's big opportunities on the franchise side in the escape rooms.
Yeah,
so they are trying to franchise those in America, and there's a company that's very big at doing these sort of master franchise agreements and then getting the sub-franchisees that's there with the escape rooms. Yeah, very possibly they might get interested in that as a concept.
Yeah. We're just moving now to a couple of recent IPOs, really on the micro cap sort of side. We've got Strip Tinning, which I think came to the market just a couple of weeks ago at 185p, and it's roughly around about that sort of level. And also Ondine Biomedical, which I think sort of like listed in December. Two different businesses, sort of like one one profitable and one obviously has got a huge runway ahead in medical. Do you want to take us quickly through both of those sort of IPOs?
Yeah, Strip Tinning is sort of into the automotive industry. It's kind of tier two. It supplies to the people that supply all the brands that we know about. And that's, it's been quite a small business. It's growing nicely. It's a family-owned business. Probably if that was all we were buying, we might have overpaid a bit much, and it would be a business of industry float. Where it's really interesting is that in electric vehicles, so flexible connectors for the battery packs, they've got launch customers on that, and they're raising money, 8 to 10 million, to expand into that marketplace. Automotive, I mean, historically is very difficult. Actually, on the glazing side, the traditional side, they make pretty good margins. But because electric vehicles is a kind of growing, all the manufacturers just want to get their hands on these products that can save them 10 or 20 kilograms. Actually, you probably do get better margins at the start. So I think they might be in a period where this can be transformational to that business for the next 2 or 3 years. Longer term, you'd have to worry about, when contracts come up for renewable, whether there's big price downs and stuff. But I think the business will be a lot bigger if we get to that point. Really, it's a play on these battery connectors for electric vehicles, of course.
Yeah, and I'd have thought electric vehicles need a lot of electrics by essence.
Yeah, I mean, the historic method of wiring was about 50 kilos, and they're taking big amounts of kilograms out of that. It's in that phase where, and there aren't a lot of people who can supply these products, so that's why they're investing. With Ondine, it's kind of a platform that's been around it's been 20 years in development. It's taken about $120 million, and it's so-called photo disinfection, where they use ultraviolet to clear. I mean, it actually can clear COVID, but it's really there for clear 99% of viruses and bacteria, MRSA, in hospitals. So it's been used and is being used by Hospital Corporation of America, one of the big guys. The reason they use it is just pure economics. So it takes infection rates in hospitals, MRSA and things, down from 3.4 to sort of 0.3. And so there's 10 years of data with that. It's going through a trial with the FCA. But the fact that they've trialed it through 80,000 patients in Canada means that it should pass its phase 2 and phase 3 test. Probably will need a bit more money, but the upside to that is potentially huge, because it's a $45 billion cost to the US healthcare system. So if you can get something that sort of helps with that, and HCA have clearly gone native on this, then there's huge upside to that one.
And how does that type of thing work in just in hospitals? Do you have a sort of like a room where you have a disinfectant room, do you, essentially, or a radiation room? Is it sort of like, or is it all over that sort of hospital? I mean,
it's actually what happens when you get admitted into the hospital. You have someone put up your nose, which is okay, slightly more pleasant than doing the COVID test, but and it uses ultraviolet, and it's just, as discussed, 99.99% of bacteria and things gone. And we often see a lot of these technology things that are an idea, and This one's had the $120 million in the 20 years sort of time spent on it. It's got HCA clearly totally on board. So, pretty hopeful.
Yeah, no, I mean, I'm totally with you. I mean, it's so dangerous, isn't it? Just in the UK, MRSA and MRSE as well. I mean, just to give you an indication, my father was in hospital only about a year ago, and he went in for a broken leg and came out with MRSE, and then was in hospital for 3 months trying to get rid of it. So, the costs associated with anybody who does get a biological or a resistant bug then is just infinitely more than the actual treatment or buying in the skills.
It's just blocking the beds and the system. They just don't want them, and as you know, particularly in the UK.
Yeah, and then finally, there's sort of some other interesting ideas. I've never even heard of this business, Serinus Energy, which I think is an E&P oil and gas explorer and producer out in Tunisia and Romania. I didn't even know they had any oil and gas out there, but obviously they do, and it's doing very well.
Well, it's it's 20 odd million. It's a small one, but it's kind of I wouldn't really want to go chasing oil and the oil price at the minute, because already there's a bit of the Ukraine factor built in this one, because I mean the small cap market's been quite weak since October really, and we've seen the oil price, the gas price go up. Serinus has had a bit of an overhang. Price is at a 5-year low, but actually where the prices are makes a huge difference, because a lot of these oil and gas companies that are small, they're always looking for the next bit of money, but clearly their costs are fairly fixed. If your commodity price goes up by a factor of 3 or 4, then they're making quite a bit more than 3 or 4 times the profit. It brings cash into the center. And Serinus, the remaining opportunity in gas, there's potentially up to 150 million barrels. Now they have to find it, but they're doing the seismic and stuff. But they do have the money to go doing that. In Tunisia, there's about 445 million barrels. Now, it's not all recoverable, and they only own 45% of it, but these are huge numbers. So as the price is higher and, the commodity prices are there, I think with Serinus, it looks like potentially by the end of next year, they'll have the whole market cap in cash. And that was off long-term sort of commodity prices. I think Dan Slater at Arden's modelling it, but if you go to spot rates, which may not be in place until the end of next year, it would have its whole market cap by the end of this year. So, we bought the stake. There seemed to be an overhang at 1.5p. Feels very cheap below 2p. Arden is saying 6p some of the parts, but you can see how if prices stay higher and Ukraine stays prices higher, frees them up so much cash to reinvest, where the thing just gets itself in a virtuous circle where it's just been incredibly difficult for these small oil companies, because we've been through a period where they've had COVID delaying drilling, and the oil price was down at 0 a year ago, and this is just so much more healthy for them really.
Yeah, it does look extremely cheap. Another one which is very cheap, but a slightly bigger in the E&P space, and I guess another one on the geopolitical play on or hedge anyway on geopolitical concerns is Jadestone Energy, which is a Singapore-based sort of oil and gas producer out in Australia and then Indonesia and Malaysia and all over Asia and Vietnam. Yeah,
so I mean, the company's been producing. They're shy of 20,000 barrels. The management team, who have bought and owned the shares, ran Talisman, where they ran sort of 10 times this amount of money. Then the shares, they've got $226 million of cash. So, they've been collecting that as the oil's been produced. The shares are sort of 92, 93p. The core is about 120p. But the real story here is this management team are positioned as one of the only buyers of assets that the majors are selling. So all the majors have said we're getting out of oil and gas, and particularly in this Asian zone. So Australia, New Zealand, Indonesia, and Malaysia, obviously where Royal Dutch has been big over the years and where there's lots of oil and gas. These guys are really well positioned to buy things at good prices, but to improve them probably through cutting operating costs, but also maybe just to do an incremental well here and there that just wouldn't ever get sanctioned by BP and Shell, because they'd be trying to do something at 500 million barrels, whereas they might be doing something clever for 10 or 15. So I think they can buy assets really well. They can grow the base of this business. It's only about a 300-400 million pound company, but as it gets bigger, I think more people get interested in it. So I think it's probably better run than some of the other mid-tier names in the UK. Arguably some of the very big companies as well. So for that reason, it's kind of a core holding. I think that'd be good for a number of years.
Yeah, and then again, just finally, a sort of trait I think that Crux sort of like looks for is excellent management. Another one is Likewise, which I think is headed up by an industry veteran, Tony Brewer, and they do sort of like domestic and commercial sort of floor covering. So the distributor. So I guess that's sort of carpets and stuff like that.
Carpets, matting. I mean, I always say to people, it's sort of sometimes the slightly interesting businesses are the most interesting shares. I wouldn't ever describe it as uninteresting, but I mean, it's every day, it's mundane, but just the attention to detail. I mean, Tony Brewer sort of set this thing up, and there was a friends and family round at 10p, which very few people would have got into. We had a tiny fund at the time. We put the money in. We really made the money at 25p, and then at 35p, he's just bought a brilliant deal off somebody who actually wanted to retire, where the kids didn't want to take up the business. It's got some cash, it's got some property, and it's just the whole thing is of a scale where it's got pretty good national footprint, and it's also a template where he can go and take people that perhaps are unhappy where they're working, he can allow them to sort of work their own territories, and each person coming on might do $1 million of turnover and deliver 300 grand of gross profit to the bottom line. So it's sort of become scalable, and just through COVID, it hasn't really missed a beat. It's hit its numbers. The numbers for this company out for this year, I mean, taken way back the level of demand from last year, which you don't see in other businesses, and said, look, it might have been an exceptional year. So I think we've got about 4 million of profits in for this year. But if you pro forma the two businesses, the acquired business and the existing business, probably should do 6 really. So it's just one that I like to own. I think potentially there's upside as well in the numbers.
Yeah, and I know it sounds maybe a bit nebulous, but with so many storms and climate change, then you get flooding all over houses all the time. So you might put a good carpet down one year, then have to rip it up and stick another one down, and it's sort of like a perpetual motion, that will.
It is, and of course, a lot of people are through the whole lockdown experience, a lot of people are deciding they want to live in different places. So move house to put new carpets in.
Yeah, of course.
And that still seems to be a thing, for all that the consumer might be perceived to be under pressure. House prices are still good, house moves are still in demand, houses selling quick.
Okay, well, brilliant. Well, thanks very much for your time again, Richard. And if anybody wants to sort of like invest in the Crux management, where's the best point to contact? Is it the website or yourself, or?
So the fund I run is the TM Crux UK Special Situations Fund, and that's available on all good platforms. But obviously, I have to caution people should take advice as to their own circumstances.
True.
I'm in no way recommending it, although obviously I have quite a bit of my own money in the fund. Yeah.
Well, thanks again then, Richard, and again, I look forward to touching base in a couple of months' time.
Thank you. That's great. Thanks very much.
Cheers. Bye.